Good afternoon, everyone. My name is Ellie Garrity, and I am the manager of Alumni Career Programs with the Alumni Association. We're excited that you're able to join us for today's webinar, New Year's Financial Resolutions, presented by Ben Offit. This webinar is a part of the Alumni Association's Professional Development webinar series, in which we hope to provide thought-provoking and valuable content that will help alumni like you achieve your personal and professional goals. If you know any fellow Terps that may have a great topic to present on, or you yourself would like to present on one of our webinars, please let me know. Okay, we have a lot of information to cover today, but Ben wants this to be an interactive webinar and will be taking questions throughout the presentation. Feel free to submit any questions using the question box located in the GoToWebinar control panel. Now, about our presenter. Ben graduated with a degree in entrepreneurship from the Robert H. Smith School of Business at the University of Maryland. He began his career in financial planning in 2009 when he discovered he wanted to combine his passions of making the world a better place while simultaneously building an unlimited business. He is a certified financial planner professional and was named a 5-star wealth manager by Baltimore Magazine in 2018, 2019, and 2020. He specializes in working with young professionals, entrepreneurs, and people approaching retirement and retirees. And now we will get started. Ben, take it away.
All right, thank you, Ellie. Should I hit start broadcast, or are you doing that?
It's already set, so everyone's ready for you.
Okay, perfect. All right, well, thank you everybody for joining me today. It's a new decade, it's a new year, and I appreciate you all joining me. I really feel like I'm at family with all of you. You guys are all Terps. I'm a Terp. I'm proud to be a Terp, and I'm just excited to give back to you here today and try to impart some knowledge that will be helpful to you this year and help you make a difference financially as you try to accomplish your financial goals in 2020. So my agenda for today, I want to give you a brief background about me. Ellie just gave a good start. I want to explain to you why issues persist with following on New Year's resolutions, give you a formula to help you solve that, connect this formula with your own financial planning in 2020. And then towards the end, we're going to give an update on the Secure Act, which is brand new financial legislation that just went through, and then some financial hacks for 2020. And then, like Ellie said, please feel free to ask questions throughout. I really don't want this to be a lecture. I really want this to be interactive and conversational. And then participate in Terp Test, which is basically a poll that I created throughout the presentation. And the winner at the end will get a special prize. And we'll also have Q&A at the end if we have time, okay? So a little bit about me, like Ellie said, I graduated in 2009. I can't believe it's been 11 years since I graduated. I was in the Smith School, the business school. I majored in entrepreneurship. I was also in the Hinman CEOs program, which is like also an entrepreneurial focused program. I started my business right after graduation, so I've been doing this for almost 11 years now. And now my wife and I live in Howard County, and we have a son named Reed. And I met my wife on the 6th floor of Elkton Hall in 2005. Lucky for me, we started dating in 2008, and here we are many years later. I'm very lucky that she's my wife. This is a picture of my grandparents and I. This is a special picture to me. My grandfather is no longer with us, but my grandparents also met at University of Maryland, and I wouldn't be here today without them, and it was very special to have them both with me at my graduation. This is my wife and I and our son not too many months ago. Our son's only 4 months old. This is maybe when he was a month old, and this is us back at Maryland. My son looks a little bit disheveled. I'm not sure why, but it was a hot day, and it was special to be with him on the campus with my wife as well. And then lastly, this was a picture my son and I took recently, and he's wearing his Maryland jacket, and it's just a happy picture. I thought it was funny and cute to share with all of you. Okay, so New Year's resolutions and New Year's in general, it actually began with the Babylonians, and they really kicked off this idea of New Year's resolutions. It started with the 10-month calendar, And March actually was the beginning of the new year. And they kicked it off with a festival to honor the gods and hopefully curry their favor in the hopes of good crops throughout the year. And then later on, Julius Caesar, the Roman emperor, introduced the 12-month year, and then he's changed it to January 1st. And this was to honor the god Janus, the god of beginnings. And this kind of cemented the idea of personally looking forward to the New Year's resolution, the annual opportunity to renew and have goals and get better throughout the year. This coincides with something called the fresh start effect. And the fresh start effect is really a psychological effect that gives sudden motivation that we often feel at the beginning of the year to make changes in our lives. And maybe many of you feel that right now. Maybe you feel like it's a new year, it's a new decade, it's an opportunity for me to have a great year financially or a great year with other goals that I want to accomplish. And that's great right now, but how do we make sure that this persists throughout the year? And that's what we'll talk about today. So this is time for our first TERP test. And the first question is, how many New Year's resolutions end up failing? Is it A, 25%, B, 50%, C, 75%, or D, 85%? So I think you can answer now on the poll on your webinar. I think Ellie will score that for us.
So we currently have a tie. 50% of people think it's C, 75%, and actually 50% also think it's D, 85%. We can give people a couple more seconds if we want to get a couple last votes in, but looks like the last two, 75% and 85%, are in the lead.
Okay, well those are two good answers, very close. The answer is 85%. So for those of you that answered 85%, congratulations, you got that right. This is kind of unfortunate, isn't it? I mean, it's kind of sad that people have so much optimism and enthusiasm at the beginning of the year, and then 85% of those resolutions don't end up working out and failing. So, my goal today is just try to impart a little bit of wisdom, if I can, to try to make a dent in that number or reduce that. And hopefully all of you can follow through with your resolutions this year. This is another great quote from a Greek philosopher, Socrates. What he's saying here is the secret of change is to focus all of your energy not on fighting the old, but on building the new. So it's not to fight the old habits, but it's to build the new habits correctly. And that'll be a theme throughout our conversation today. What prevents progress and real change on our New Year's Eve goals? Well, one of them is we try to change too much at once. We try to take on too much. We're very ambitious at the beginning of the year. We're trying to do too much at the beginning. Number two, we try to change a habit that's too big. Maybe it's too audacious. And then number three, we tend to focus on the results instead of the activities that help us get there. So again, the secret of change is to focus all of your energy not in fighting the old, but on building the new. So again, that comes full circle. We'll talk about that again here today. So here's my formula that I think can apply not just to financial outcomes, but really to all objectives that you might have for 2020 or all resolutions you might have for 2020. Number one, start with why, and we'll dive into that in a moment. Number two, not too much or not too big at once. We just talked about that briefly. And then number three, focusing on smart activities. That's what will get you results. Okay, so number one, start with why. What does that mean? So this guy, Simon Sinek, you all may have seen or heard about. He's essentially, maybe a modern day philosopher or a guru. And he created this whole presentation about starting with why, about, why is that important to you? Why does that matter? And really honing in on the core of what's most important to help you drive execution. And that's something that I believe is very important as you want to strive to achieve not just your financial goals, but all goals. So think about it for yourself. Why are you here today? Why is it important to you? What are you thinking about from a financial perspective? This has to elicit a very strong emotional response and a personal feeling, and it's got to be something that you truly, truly desire. And if you think about that at its core, that can connect to whatever your objective is to help you to follow through. So This is a picture of two gentlemen in the Depression era, and I showed you a picture of my grandparents earlier. They both are children of the Depression era, and that definitely motivated them from a financial perspective and from a life perspective. And that was part of their why. So these two gentlemen here, are desperately seeking a job. And I think a lot of, children from that era, maybe you've got grandparents or great grandparents that are still living, can, relate to that experience. And their lives were shaped by, having parents that might have been unemployed or out of work, or maybe didn't have much money to utilize. And then, so, maybe as a result of that, they became really good savers or really frugal or really focused on, having a great career and really working hard. So this is certainly a why for, my grandparents. And this is just an example of something that can drive you emotionally and personally throughout the year. Number two, so we talked about this, not too big or not too much at once. The simpler, the better, okay? If you make it simple, it's easier to follow through. We don't want to bite off too much of the apple at once, or else it's hard for us to actually get things done. We also want to try to quantify our goals and break it into quarters or bite-sized pieces, so we actually can, make progress step by step. So an example of this from a health perspective is a lot of people in the new year want to get healthy, they want to lose weight, whatever. And they say, I'm going to start going to the gym 5 days a week at 5 in the morning. Well, for someone that's never been to the gym, that's probably too much at once. That's such a drastic change. Maybe they could start going to the gym 1 or 2 days a week, or just a smaller commitment instead of going whole hog into every day, at 5 in the morning. And then that's probably not going to last throughout the year. Okay. Another example of this is someone that wants to cross the Grand Canyon on a high rope. They don't want to focus on the end. They don't want to focus on one side to the other. What they do is they focus on taking one step at a time, one step at a time, one step at a time, and they focus on the rope. And if they do that, that allows them to reach the other side. But if they're only focused on the other side, it might be too much to handle, at once. So if you take it one step at a time, this relates back to our concept of not too big, not too much at once. And then step number 3 is smart activities, okay? This is TERP test number 2. What does SMART goals actually stand for? Is it A, smart, measurable, actionable, real, time-bound? Is it B, specific, measurable, attainable, relevant, time-bound? Is it C, serious money always reaches TERPs? Or D, specific, momentum, achievable, realistic, technical? So let's see what the TERP test comes in for that.
Okay, so the majority of folks are voting for B. We have a couple people that are voting for A. And I'll give everyone another second to get their last votes in. And it looks like we have about 70% for B and 30% for A.
Okay, we have a pretty smart group. Not surprising, because it's a room full of TERPs. You guys are correct. It is B. So specific, measurable, attainable, relevant, time-bound. So you hear about SMART goals a lot. It's a very popular terminology, but we often fail to meet SMART goals, and that's a problem. It causes us to give up. So going back to the weight loss example, a lot of people in the new year say, I want to lose 15 pounds, okay? And maybe they set a goal that I'm going to go to the gym, 5 days a week at 5 a.m. and lose 15 pounds by the end of the first quarter, March 31st, 2020. And then what happens is they get on the scale that day and they've only lost 11 pounds. So what do you think happens? They say, well, I didn't hit my goal. I didn't do well enough, and they give up. And they go back to the bad habits that they had in 2019. They stop focusing on losing weight or going to the gym. So SMART goals can be problematic in that regard. And that's why I say it might make more sense to replace them with SMART activities. So SMART activities is focusing on the action, not the result. So focusing on the action that helps you get the result, doing the activity in support of the goal that you greatly desire achieving, and focusing on what you really want so you're accountable to those steps. Lastly, I said in here, and this is some research that's been done, a habit can take anywhere from 18 to 254 days to actually stick. So we need to try to follow through on our activities on a regular and consistent basis in order for them to stick and really, make a difference in our lives, or else they'll just be, washed away. Also, sometimes what we just need to do is trick ourselves into the behavior that we want to have in order to get the results that we want. So again, going back to this fitness or weight loss opportunity, if someone really wanted to lose weight and they think that they're eating too much junk food, just don't have junk food in the house. Physically, don't buy it. Don't have it in your pantry, and then you won't have the opportunity to eat it. So sometimes you need to create a circumstance that the only outcome is the outcome that you want. Another example of this that I give to clients is, let's say that you try to wake up every morning at 7:30 in the morning, but you have a problem and that you always hit the snooze button. So that alarm clock that's supposed to wake you up at 7:30 in the morning is not actually doing its job because you're getting in the way of it by hitting the snooze button. So then, what you might do if you really wanted to get up at 7:30 is you might put it down the hallway, two doors down. So what that does is it physically forces you to walk down the hall, get up out of bed, and then go to the other room and turn off the alarm clock, or otherwise it's just going to keep going and keep bothering you. So that actually gets the result that you want. Another example is you could, have your coffee machine, coffee roaster, go off at 7:30 in the morning. And if you're not down there in a couple minutes, it's going to overflow all over your countertop. So this is just a way to, structure your environment and kind of trick yourself into getting the outcome that you want. So, this philosophy directly correlates with money and finances, whether it be accomplishing a fitness goal or waking up at the time that you want each day or doing better with your finances or certain money objectives that you have in 2020. This technique and this formula is applicable to all of them. So let's try it together. Let's go through the formula that we talked about earlier. Step one, start with why. So, think about where you are now. Think about where you want to be financially. Why are you here? What's driving you to be on this webinar today? Think about, on a scale of 1 to 10, how do you feel about your finances? What score would you give yourself? Are you a 10? Probably not. Are you a 5? Okay, maybe. Are you a 7? Whatever score you give yourself, what's in between, 7 and 10? What's in between 5 and 10? What's getting you from being a 10? And that's really where the magic happens. Whatever your answers are to that, that's really going to be the starting point for you to be successful with your own finances. I think what the issue is that's in between that score getting to 10, and that's really the first point that you'd want to start with from a financial perspective in 2020 to focus in on. And then instead of being vague about that, just saying, well, I want to move from a 7 to a 10, or I want to be better, with money in 2020, be very specific with it and have that, very really desired outcome that you want, and have that emotional connection to it. So an example is, this is actually a client that I had, he said that I'm a 6, and he said that in order to get to a 10, I want to have $50,000 saved up by the end of the year. And I asked him, why do you want to have $50,000 saved up by the end of the year? Why would that make you a 10? And he said, well, I want to buy a house in Santa Fe, New Mexico. And I said, well, why do you want to buy a house in Santa Fe, New Mexico? He said, well, my dad was from there, and my dad passed away when I was 9 years old. And I've always wanted to have a place there to feel that connection with him or feel closer to him. So that was a very meaningful financial goal that he had. So it really meant something to him to get to that $50,000 by the end of the year, so he could go use that money to put a down payment and buy a house in Santa Fe, New Mexico. So I would encourage all of you to think that way as well. Whatever financial goal that you have, why is that important to you? Why does that matter? And that's starting with why. Step number 2. So let's go back to that example. Not too big or not too much. So this guy said to me, well, I've got $26,000 saved up now, and I need to get to $50,000. So I need to save $24,000 more this year to achieve that objective. So now we're starting to break it up. Instead of this big goal of, wow, I need to save 24,000 this year, we broke it up into saying, well, I need to save, 6,000 a quarter. And then we broke that into, well, I need to save, $500 a week in order to get 6,000, by the end of this quarter. So we started to move towards that objective of saying, well, how do we get to 6,000 by March 31st, 2020, the first quarter? And we broke it into saving $500 a week. And that gets into SMART activities. So again, specific, measurable, attainable, relevant, time-bound. So now we have an action phrase that correlates and ties all of this together. I need to save $500 a week in order to accomplish my goal of having $6,000 by March 31st, 2019, so I can be on track to buy my dream house in Santa Fe, New Mexico. Okay? So whatever your financial objective is, maybe it's paying down debt, maybe it's saving more for retirement, maybe it's saving for education, or whatever your financial goal is, you can start to break it down into a quarterly goal and break it down as small as you can so it's more achievable. Remember that picture I showed you of the guy trying to cross the Grand Canyon? Instead of trying to take on something that audacious, he focused on the rope, one step at a time. And that's the same thing you need to do with your goals as well. When it comes to finances, saving automatically can help us get what we want. So a 401k plan, or a retirement plan through your job is an example of this. It works really, really well because it's automatically occurring and it's forcing you to save money. So if we can do that, whether it be saving for a house in Santa Fe or saving for retirement, whatever it is, if we can create automation, that's going to help us force the results that we want as well. This is just an example. Maybe it's not quite as simple as just saving, for a house in Santa Fe all year, but maybe, before we even get the opportunity to save $500 a week, maybe we need to figure out how we can help, someone get there. So maybe someone has credit card debt that's getting in the way of that. Maybe they've got student loan debt that's getting in the way of that. Maybe they're spending too much money in other places of their cash flow. So we need to review their cash flow structure and system. So maybe quarter one is not saving $500 a week. Maybe it's really coming up with a concrete plan to pay off your credit card debt this quarter, or having better spending habits or cash flow habits, or maybe it's lowering your student loan payments in some capacity. And then maybe in quarter two, we come back to that saving $500 a week. And the way that we would do that is controlling your spending by only allowing you to live on $250 per week of spending. So if we can create a cap on the spending, that would allow you to actually save $500 a week. And then maybe in quarter three, we get into investments. In quarter four, we get into other financial objectives, estate planning, tax strategies, real estate considerations. This is just a sample agenda as to how you could structure your year depending on what your goals are. So going back to that example that I just showed you, did we utilize our formula? Did we start with the why for that client? Yeah, we did. We identified why he wanted to save that money and why that was so important to him and why that meant something. Number two, we structured a way so it wasn't too much to take on at once. It wasn't too big. It was only saving $500 a week. It wasn't focusing on just saving 24,000. And then we related that back to SMART activities. Focusing on what activity can we do to create that result. So that's what will create results for you. This is something that we actually use with clients. This is the way that we do that. We have a goal tracker. Essentially what we do is just like we just showed you. Let's say you've got a goal that you want to accomplish or various goals you want to accomplish. We'll identify that in the goal section. And this is something you could use as well, just for your own purposes. And you can identify what is the next step that I need to do to get that done. How do I start moving this in the right direction? And you keep track of it. You outline it. It's simple, but it's effective. And you can track down here what you've completed. So you can see where you've made progress, what you've done well, and what's still on the agenda for you to get done. And what we do with our clients is after we've gotten over, their most important goals, then we transition to this structured financial planning process throughout the year. We're not necessarily talking every single month. We have things on the calendar to ensure that accountability and to ensure that we're getting things done on a regular basis. So it's we're pinpointing on the calendar, what do we need to get done throughout the year to make sure that things get done and that people make progress with their financial objectives. Does this philosophy or does this, process sound too simple? If it does, I think that's good. I think the whole point of this is execution on the simplicity will drive your financial results. And, that's a big focus of this presentation and what I think will help you be successful this year. Okay, we haven't had any questions yet. And if you do have questions, again, please enter them in the chat box yet. This doesn't just need to be a lecture from me. Feel free to chime in if you've got things you want to go over. This is TERP test number 3. What are some financial goals that you have in 2020? A, save more. B, pay down debt. C, invest more efficiently for growth. D, protect your future and your family. Or E, save on taxes. So Ellie, let's open that up as well.
Yep, I'm going to give people a little more time to vote. We have answers kind of spread throughout, so I'll give people a second and then I'll come back and let you know, Ben.
Okay.
Okay, looks like 75, and people were able to vote for more than one, but 75% of folks said they were interested in learning more about investing more efficiently for growth. And then
75%?
next, 70, it just went up to 76.
76%.
Yeah, and then the second highest is 48% looking to save more, and then a close third with 42% looking to protect your future and your family.
Okay. So 76% invest more efficiently for growth, and then 40-some% for saving more and protecting future and family.
Mm-hmm.
Okay. So, I'll just try to answer that, briefly. So, investing more efficiently for growth, I think, comes down to the two essential keys to investing well are two things. It's diversification and asset allocation and investor behavior. A lot of times people think that it's due to, timing the market or it's security selection. That's really not what makes you a successful investor. That might be, sexy to talk about at a party, but really what's going to make you successful and more efficiently investing for 2020 is those two things, to manage your behavior and to be appropriately diversified and have a good asset allocation. When I say managing your behavior, what that means is, when the market is up, not getting too greedy and not trying to chase things that are up, and when the market is down, not getting too fearful and changing your plan or changing your investment strategy. But what happens is people, self-sabotage and they make the wrong investment choices over and over and over again without realizing it. They say, well, Amazon's really up right now, so I need to put more in Amazon, or international is not doing as well as the S&P 500, so I need to shift everything to the S&P 500. Well, what you're doing is you're actually doing the wrong thing, is you're shifting your money into something that's already appreciated and it's already high in value. So you're going to be buying at high prices. Instead, what we want to do is we want to buy at low prices. So it might sound counterintuitive. We want to buy something when it's low in price or down in value. And then conversely, what happens is the market goes down, and then people say, well, this segment of my portfolio is doing terribly. Why did I ever invest in anything besides the S&P 500? Because that's up and everything else is down. I'm going to sell out of this international portion of my portfolio. It's not what you want to do, because you don't want to sell when the market's low. Okay, that capitalizes the loss. So if you think about if you had real estate, for example, would you want to sell your house when it's down in value? No, you don't. You want to sell it when it's up in value. So investor behavior is important, and then asset allocation is important, having exposure to all the major asset classes. So you're not just all concentrated in one. So you have large cap, mid cap, small cap, international developed markets, international emerging markets, commodities, fixed income, et cetera. I can talk to you more about investing if you want, but that's a good starting point for that one. Saving more, I think that goes back to what we just talked about a moment ago. Do you have an infrastructure set up to help you save more money throughout the year? Do you have a system, an accountability? Do you have the cash flow squared away to allow you to save what you want to save towards. It's saving more towards retirement or your kids' education or your future or a house, whatever it might be. You need to create the cash flow to allow you to save more. And that's really a cash flow conversation, and maybe you need to pay off some things to allow you to do that. And then lastly, protecting your future and your family. There's a lot of ways to do that. A lot of times that could mean insurance, life insurance, disability insurance, long-term care, auto, homeowners, umbrella, but it's having the defensive side of financial planning addressed. If something were to go wrong, have you accounted for that? Have you made sure that you're going to be covered? And the purpose of risk management and insurance at the end of the day is to provide liquidity and provide capital when you need it the most for yourself and your family. Okay, so thanks for answering that with TERP test number 3. All right, does anybody want to give their answers? Anything specifically? If anybody wants to chime in and say, this is my financial goal for 2020, and I could help you, give some feedback. And if you don't want to do that, that's fine. We won't bite. This is a pretty cute picture of a dachshund puppy. I'm a big dachshund fan. I've got dachshunds myself. But if anybody wants to volunteer and chime in the chat or ask a question, I'm happy to try to answer maybe one person's objective for this year, or how you might be able to structure that in 2020.
I'll just give it a second, Ben, to give folks a second to either chat in what your goal is, or you can put it in the question box as well.
Okay. And if no one does go, I do have a couple other things to go over with you at the end. I've got the Secure Act and then some financial hacks for 2020. But we'll see if anybody does chime in or step up.
We haven't gotten anyone to bite just yet, but hopefully we can get a couple folks before the end of your webinar.
Oh, we just got one. I see one.
Ah, great. Okay, thank you, Enrique. So, Ben, if you're able to see this one, do you want to read it to everyone?
Yeah, it says improve FICO score to 850. That's a great question. So I think one of the first things that you want to potentially do there is get a copy of your credit report and then see what your score is right now. And then if it's not 850, your report can highlight some of the reasons why that is. Maybe you have some outstanding revolving debt. Maybe you have too high of balances. Maybe you don't have enough credit exposure. Sometimes it can be helpful to have a car loan or auto loan or credit cards, something that shows you've got consistent credit history that you're paying on a regular basis. So we just have to look at the report and see what it's saying to us. But typically, it's a combination of building credit by paying bills down on a regular basis, and then establishing a good credit history as well. I'm sorry, is there a further response here? Let's see here. Okay, we've got one about the portfolio. I'm interested in learning more about passive versus active investments to diversify my portfolio. That's a great question. Personally, I think you can be successful with passive investing or active investing. I know that there's a lot of investing pundits that say, only do passive, or only do low-cost index funds or ETFs, or only do mutual funds, whatever. My personal belief is that either way can work. Philosophically, with active funds, what's going to happen is you're going to have a higher expense ratio, and you're going to pay more to have those. But it doesn't necessarily mean it's worse, because what you're going to have is you're going to have actively managed funds by a team of really smart people that are analysts all day looking at that fund, at that portfolio, or at that at that mutual fund, let's say, and they're trying to help you do better than just the market itself. So you do pay more, but ultimately you should get more in the long term. With passive, that also can work. That's low cost, lower expense ratio, so that you're not going to have an active team of fund managers, looking at your portfolio on a day-to-day basis, trying to beat the market. But you save some money there, and that hopefully can pass through to your returns. So my belief is whatever suits your fancy, if you're active or you're passive, either way can work. It's just a matter of what you prefer. What do I do for my own? That's a good combination. That's a good question. Actually, I do both. So some asset classes I prefer to be active, and some asset classes I prefer to be passive. Um, so yeah, I'm definitely not a believer in all one or the other. I think there's a combination of both. Okay, good questions, everybody. We can have some more questions in a bit. I just want to get to a couple other things here. All right, other notable acts for 2020. So I'm not sure if you all have heard about this, but there's something called the Secure Act that just went into legislation. This is brand new, and it does change some of the financial rules that are out there. So if you're familiar with what RMDs are, that stands for required minimum distributions. If you're at the age of 70 and a half years old, that used to be the age that you need to start taking withdrawals from your portfolio or your IRA or your 401k or your 403b, whatever retirement account you have, because that's all pre-tax dollars. And the government was saying, well, you need to start taking withdrawals at 70 and a half so we can collect our tax revenue on that. That has just been bumped up to 72. So if you're near that age, that's good to know, because now you have another year and a half essentially to defer dollars without taxation. So that's a good thing. Traditional IRA contributions beyond 70 and a half are now allowed. That's also a good thing, because that used to not be the case. If you were older than 70 and a half, you couldn't make a contribution that was tax deductible into a traditional IRA. Now you can. Something that did change that's not as advantageous is if you're a spouse and you have your spouse that passed away, unfortunately, it used to be you could roll that into a spousal IRA and then take withdrawals from that over the course of your lifetime. Well, now that account needs to be withdrawn within 10 years. So essentially the government is saying you need to take the taxes out of it and liquidate the account within 10 years. That's not as good. Some other positive changes though: 5,000 penalty-free withdrawal from IRAs for birth or adoption expenses. So this is a positive thing. So if you've got expenses pertaining to those, you can take $5,000 out of your IRA or retirement account without a penalty. There's existing exceptions to a 10% penalty that have already been in existence, like medical expenses or disability, or higher educational expenses or first-time home purchase. Those are still around. This is just a new exception, which is advantageous. For the ability to deduct medical expenses, that's down to 7.5% of your AGI. That's kind of vacillated between 10% and 7.5%. So now it's back down to 7.5%. So if you do itemize your deductions in 2020 and you do have a lot of medical expenses, keep in mind that if they're over 7.5% of your adjusted gross income, those can be deductible. And then lastly, you can now take $10,000 out from your 529 account to pay student loans. So 529 is a great way to save money for educational expenses. But now you can actually take money out just to pay down student loan debt if you still have money in an account and you have student loans already. So those are some of the changes from the Secure Act, which just went through. So it's important to be aware of these changes. And here's some financial hacks for 2020. Number one, I said max out your contributions if you can to your retirement account at your job. So maybe it's a 401k or a 403b or 457 plan. The max in 2020 has been bumped up to 19,500. It was 19,000. It's been bumped up by 500. And if you're over the age of 50, you can do catch-up contributions at $6,500 on top of the 19,500. So the more that you can save, the better. It's also a good tax deduction. Number two, see if you can do that as soon as possible. The sooner that you have the money into the market, the better. The sooner it's invested, the more time you have to grow. So if you can afford that, if you can, max it out by the first half of the year or the first quarter of the year, if you have that income level, do it instead of just waiting throughout, the rest of the year. More time in the market is better. Number three, take advantage of an HSA or a health savings account. This is the only bucket in the financial landscape that's triple tax-free. So what I mean by that is that if you make a contribution, if you're an individual or single, $3,550, or if you're a family or a couple, $7,100, that goes in fully tax deductible when you make the contribution. The money stays in there without taxes, and then when we withdraw it to use for health-related expenses, it all comes out tax-free. The only bucket that's out there that has that capability. It's a great bucket if you have it with your health insurance plan through your job. So take advantage of that. If you're over age 55, you can do an additional $1,000 above and beyond those limits. Number four, Consider refinancing your mortgage, student loans, or other debt if you have it. Interest rates are low right now. So if you've got a mortgage from years ago, you might be able to get a lower rate now, but there are some costs to doing that. So you want to be mindful of that. But if you can get a lower rate, it could make sense. Same thing with student loans. If you've got student loan debt, maybe you're paying at a higher rate. Maybe you're paying at 6% or above. Maybe you could get 5% or 4% or even lower. So could be a good year to look at that. And then number 5, consider an online savings account. Regular traditional banks, for cash and savings and money markets are paying, 1% or less, maybe 0.5% or less. Online savings accounts sometimes are paying 1.5 to 2%. So if you do have a good amount of cash, you might want to consider an online account. If they're all FDIC insured, this can help you to have better yields in your cash. Number 6, if you have credit card debt, consider a 0% interest card. What that means is transferring it to another credit card for 12 months or 15 months or 18 months, where you won't have to pay an interest rate. That'll give you time to pay off the interest rate without interest, or pay off the debt without interest, with time. Or if you need to, maybe a 401k loan or a 403b loan. This is money that you can take out of your retirement account without a penalty, without taxes. It's just a loan that's advanced to you, and you pay that back through your salary contributions over time. There is an interest rate on that, which is low, but that interest rate actually goes back to your own account. So it's kind of cool. Number 7, we did talk about investments a little bit. Re-examine your investments. Equities long-term are going to outperform fixed income, so just be mindful of that. There's a difference between risk and volatility. What I mean by that is a lot of times people consider, equities to be more risky than fixed income. I don't necessarily agree with that, because fixed income is going to have less volatility, means less up and down movement, but it's going to grow less long-term than equities will. So since equities are going to outperform fixed income in the long term, your portfolio is going to grow to be a higher amount, and that actually reduces the risk of the loss of purchasing power, because you're going to have more money in the account long term. So that's a deeper conversation, but that's a tip. Number 8, love the Roth. So Roth IRAs, Roth 401ks, Roth 403bs, Roth conversions. Basically what that means is if you put money into a Roth, you're putting it in after-tax dollars. It's going to never be taxed again. So all that money compounds and grows over time. If you take it out in retirement, it's all tax-free. It comes out tax-free upon death as well. So I love a Roth if you have access to one. If you make too much money and you can't use a Roth IRA, you might have a Roth 401k through your job, which has no income limitation. So you might want to consider that. And then sometimes it could make sense to convert your IRA to a Roth. But before you do that, make sure you talk with a tax advisor, because there are some tax considerations with that. Number 9, we talked a little bit about this. Examine your insurance portfolio. It's good to make sure you're defensively oriented and you're not missing something from a life insurance standpoint, disability insurance, long-term care. You don't want to be exposed when the tide washes away. If something, God forbid, happens, you need to claim on this, you want to have strong coverage. And then lastly, number 10, consider an in-service withdrawal if your plan allows. If you're over the age of 60, sometimes you have a retirement plan at your job that might allow you to roll that into your own IRA. That can make sense, because sometimes you can have better investment options outside of the plan. So you might want to talk to your financial advisor and see if that makes sense for you. Number 11, save every month, even if it's small. Make that a habit. Do it on a regular basis, even if it's something small. It's better than nothing. Number 12, scrub your subscriptions and cancel the ones that you aren't using anymore. In today's society with iPhones and iPads and Google, it's so easy to sign up for applications and subscriptions that you forget about and you're paying for and you're not using. So really make sure you go through your phone or go through your tablet or whatever, go through your bank account statement and make sure you're canceling subscriptions that you're not using anymore. It's a waste of money if you're not using it. That coincides with number 13. Tracking where your money goes. That's very important. Know where your cash flow is going. People would be surprised at how much money they actually could utilize if they knew that it wasn't just being spent in frivolous ways. And then number 14, make payments even if small on your higher interest debt. If you've got a higher interest debt, that's let's say 7, 8, 10%, 15%, 20%, whatever it is, that's going to be the best utilization of your money. Before saving money into a 401k or a Roth IRA or whatever, if you've got really high interest, you want to pay that down first, because you're going to realize a rate of return immediately if you pay that down. So you'll realize a 17% rate of return if you pay off a debt that you owe 17% on. So just keep that in mind. We want to balance saving and investing with paying down debt. But if you do have high interest debt, make sure you pay that down. Okay, so thank you all for being here. I mentioned there was going to be a prize winner, and you guys all did a great job in answering these questions, and you guys are all winners. And just to be honest, I wanted to find a way to get this video into my presentation. I saw this video this year, and it always put me in a good mood. It always cracked me up. It's just really a silly video of goats dancing to music. So that's your prize. I'm going to play that for you. What a great prize. That's got to put a smile on your face. Okay, and then lastly, my last piece of wisdom is, to express love in 2020. So my belief is that, my purpose in life is to spread love and create love. And, money is one thing, but money at the end of the day is just a conduit. It's a financial vehicle that allows you to express your values and create an impact in society and create an impact in your family. So money is just a tool that allows you to accomplish, different personal objectives. So, use your money wisely. You can use that for your family. You can use that for yourself. You can use that for your future, and use it in a positive way that allows you to express your love in 2020. And then lastly, if you did have any questions about the presentation today, or you wanted to talk further, or have questions about, your situation or whatever, here's our contact information. Here's my contact information. Feel free to reach out. We'd be happy to talk with you. And I think that's really it. I know we're bumping up on time. If we do have any, time for questions, Ellie, I'm happy to answer them, but I don't know if we do or we don't.
Great. Yeah, we definitely have time. We have a question from Becky. I can read it to you if that's easiest. She is 28 and married, and both her and her partner are maxing out their 401ks. She doesn't have a match, but he has a 3% from his company. Do you recommend that they do Roth or traditional? They plan on contributing to individual IRAs. Any recommendation for the
So they're
Roth
both
versus
maxing
traditional?
out, both maxing out your retirement plans to your job. If that is the case, there's a couple things you need to be mindful of. If you're already doing that, well done. That's great. That's a great thing to do. But what that does is it makes you what's called an active participant in a company-sponsored plan. So depending on your income level, if you do contribute to traditional IRAs outside of that, they might not be tax-deductible contributions. So you want to be mindful of that because it might not work to your favor as much as you might think it will. And then from a Roth, if you can do a Roth, great, but there's income limits on the Roth IRA. So I think in 2020, if you're married, I think it's like under 186,000 of combined income, something like that. So you'd want to check that because you can't contribute to a Roth if you make over that threshold.
Great, thank you. And then we had a couple people asking if there'll be a recording of the webinar, if they could have a copy of the PowerPoint. And just so everyone knows, I will be sending out a recording of the webinar, the PowerPoint, and Ben's information after this webinar, and it'll be sent to the email address you used to sign up for this webinar. But that looks like that's all of our questions for today. Ben, is there anything else you wanted to cover before we wrap up?
No, like I said, I appreciate the opportunity. This has been great. It's great to be here with other Terps. And, I hope you just, really take this in stride and you actually implement a lot of these things we talked about here today, and don't just let this be a webinar you listened to at the beginning of the year and then you forgot everything we talked about. I think if you actually do try to follow through with a lot of what we talked about here today, I think you'll look back and you'll have made great strides financially throughout the year. So really take it to heart and do it.
Great. Well, huge thanks to you, Ben. Thank you so much for volunteering today and for giving us such a dynamic presentation. And thank you to everyone for joining us. We hope to see you soon and have a wonderful day. And of course, go Terps.
All right. Thank you.